Welcome to session 3 in lesson 2 of course 2 Capital Markets. In this session you will study markets and conclude if they are efficient or not. The learning goals for session 2.3 are: you should be able to argue about the efficiency of a specific market. You can describe how market efficiency has been explored on mutual funds and analyst performance. And you know the assumptions, implications, and applications of market efficiency. Are markets efficient? The efficient market hypothesis does not exactly arouse enthusiasm in the community of professional portfolio managers, as it implies that a great deal of the activity of these managers are at best wasted effort. Consequently, the efficient market hypothesis has never been widely accepted on Wall Street, and the debate probably will never be settled given the following three issues. First, the magnitude issue. All might agree that stock prices are very close to fair values and that only managers of large portfolios can earn enough trading profit to make the exploitation of minor mispricing worth the effort. Let's have a look at the example. If you have only $100 and you actually earn 1%, your profit is going to be $1. If you earn the same return of 1% on 10 million, you're going to make exactly $100,000. You see, that's a lot of money in nominal terms, but it's the same return. Second, the selection bias issue. Suppose that you discover an investment scheme that could really make money. Only investors who find that an investment scheme cannot generate abnormal returns will be willing to report their finding to the whole world. This is a problem in selection bias. The outcomes we are able to observe have been pre-selected in favor of failed attempts. Third, the lucky event issue. In virtually any month, it seems, we read an article about some investors or investment companies with a fantastic investment performance over the recent past, but there may also be many big losers we never heard about. A doubter will call the result luck, the successful investor will call it skill. As an example, it can be compared to the probability of throwing a coin and have 6 times in a row face. This is equal to 0.5 times power 6, or 1.6%. Now, in a group of 100 people, it is likely that one will actually succeed by luck to have 6 times in a row face. The same can be applied to the investment industry. The weak form test shown with the momentum effect. Early tests of efficient markets were tests of the weak form. Could speculators find trends in past prices that would enable them to earn abnormal profits? This is essentially a test of the efficiency in technical analysis. In an investigation of intermediate horizon stock price behavior using 3 to 12 months holding periods were analyzed by Jagadesh and Titmond. They found a momentum effect in which good or bad recent performance of particular stock continues over time. They concluded that while the performance of individual stocks is highly unpredictable, portfolios of the best performing stocks in the recent past appear to outperform other stocks with enough reliability to offer profit opportunities. There is evidence of short to intermediate horizon price momentum in both the aggregate market and cross-sectionally. In the weak form test, we are looking at the reversal effect. The reversal effect is a long horizon effect in which losers rebound and winners fade back, suggesting that the stock market overreacts to relevant news. After the overreaction is recognized, extreme investment performance is reversed. This phenomenon would imply that a contrarian investment strategy, meaning investing in recent losers, avoiding recent winners, should be profitable. Moreover, these returns seem pronounced enough to be exploited profitably. It appears that there may be a short-run momentum, but a long-run reversal pattern in price behavior, both for the market as a whole and across sectors of the market. One interpretation of this pattern is that short-run overreaction, which causes momentum in prices, may lead to long-term reversals when the market recognizes its past errors. Predictors of broad market returns. Several studies have documented the ability of easily observed variables to predict market returns. For example, Fama and French showed that the return on the aggregate stock market tends to be higher when the dividend price ratio and the dividend yield is high. Campbell and Schiller found that the earnings yield can predict market returns. Kim and Stambach showed that bond market data such as the spread between yields on high and low-grade corporate bonds can help to predict broad market returns. Semi-strong tests shown on the small firm anomaly. Easy accessible statistics, for example, a stock's price-earning ratio or its market capitalization, seem to predict abnormal risk-adjusted returns. Findings such as these, which we will review in the following pages, are difficult to reconcile with the efficient market hypothesis and therefore are often referred to as efficient market anomalies. Let's have a look at the so-called small firm effect. As in the graph below, it shows the historical performance of portfolios formed by dividing the New York stocks into 10 portfolios, each year according to firm size. Average annual returns between 1926 and 2015 are consistently higher on the small firm portfolio. The difference in average annual return between portfolio 10 with the largest firms and portfolio 1 with the smallest firms is 7.65%. Of course, the smaller firm portfolio tends to be riskier, but even when returns are adjusted for risk using the CAPM, there is still a consistent premium for the smaller size portfolios. In the semi-strong tests, it can also be shown the book-to-market anomaly. Fama and French showed that a powerful predictor of returns across securities is the ratio of the book value of the firm's equity to the market value of equity. As shown in the graph below, he stratified firms into 10 groups according to book-to-market ratios and examined the average monthly rate of return of each of the 10 groups. The decile with the highest book-to-market ratio had an average annual return of 17.2%, while the lowest ratio decile averaged only 11.1%. So this is a significant result in a difference of 6.1%. The dramatic dependence of returns on book-to-market ratio is independent of beta, suggesting either that high book-to-market ratio firms are relatively underpriced, or that the book-to-market ratio is serving as a proxy for a risk factor that affects equilibrium expected returns. In fact, Fama and French found that after controlling for the size and book-to-market effects, beta seemed to have no power to explain average security returns. Let's discuss three additional anomalies. First, the price-earnings effect. It's showing that portfolios of low price-earning PE ratio stocks have provided higher returns than high PE portfolios. The PE effects hold up even if returns are adjusted for portfolio beta. One interpretation of these results is that returns are not properly adjusted for risk. Second, the neglected firm effect. It is showing that neglected firms might be expected to earn higher equilibrium returns as compensation for the risk associated with limited information. In this sense, the neglected firm premium is not strictly a market inefficiency, but is in fact a type of risk premium. Third, the effect of liquidity. The effect of liquidity on stock returns might be related to both the small firm and neglected firms effect. Investors will demand a rate of return premium to invest in less liquid stocks that entail higher trading costs. Small and less analyzed stocks, as a rule, are less liquid. The liquidity effect might be a partial explanation of their abnormal returns. The high trading costs on small stocks can easily wipe out any apparent abnormal profit opportunity. Let's have a look at strong form tests in terms of insider information. It would not be surprising if insiders were able to make superior profits trading in their firm stocks. In other words, we do not expect markets to be strong form efficient. Ability of insiders to trade profitably in their own stock has been documented in studies by Jeff, Seyun, Givoli, and Palamon and others. It was documented the tendency for stock prices to rise after insiders intensively bought shares and fall after insiders intensively sold shares. The Securities and Exchange Commission requires all insiders to register their trading activity, and it publishes these trades in an official summary of security transactions and holdings. Can other investors benefit by following insider trades? A study showed that although there is some tendency for stock prices to increase even after the official summary reports insider buying, the abnormal returns are not of sufficient magnitude to overcome transaction costs. Interpreting the anomalies. How should we interpret the ever-growing anomalies literature? Does it imply that markets are grossly inefficient, allowing for simplistic trading rules to offer large profit opportunities, or are there other, more subtle interpretations? The small firm, market the book, momentum, and long-term reversal effects are currently among the most puzzling phenomena in empirical finance. One argumentation used by Fama and French is that these effects can be explained as manifestation of risk premiums. Others, such as Lakonischuk, Schleifer, and Wishny, see this as evidence of inefficient markets, more specifically, of systematic errors in the forecast of stock analysts. Interpreting the evidence. We have covered many of the so-called anomalies cited in the literature, but our list could go on and on. Some wonder whether these anomalies are really unexplained puzzles in financial markets, or whether they instead are an artifact of data mining. One way to address the problem of data mining is to find a dataset that has not already been researched and see whether the relationship in question shows up in the new data. Anomalies over time. While no market can be perfectly efficient in well-functioning markets, anomalies ought to be self-destructing. As market participants learn of profitable trading strategies, their attempts to exploit them should move prices to levels at which abnormal profits are no longer available. The role of stock market analysts. For investors, the issue of market efficiency boils down to whether skilled investors can make consistent, abnormal trading profits. The literature suggests that some value is added by analysts, but ambiguity remains. Are superior returns following analyst upgrades due to revelation of new information or due to changes in investors' demand in response to changes outlook? Also, are these results exploitable by investors who necessarily incur trading costs? Mutual fund performance. Analyzing mutual fund performance in terms of consistency, the following key findings were identified. Carhart found that there is only minor persistence in relative performance across managers. Moreover, much of that persistence seems due to expenses and transaction costs rather than gross investment returns. However, Bollen and Busse do find evidence of performance persistence, at least over short horizons. Burke and Green argued that skilled mutual fund managers with abnormal performance will attract new funds, until the additional cost and complexity of managing those extra funds drive alphas down to zero. Thus, skill will show up not in superior returns, but rather in the amount of funds under management. So to conclude, are markets efficient? In a summary, there are enough anomalies in the empirical evidence to justify the search for underpriced securities that clearly goes on. The bulk of the evidence, however, suggests that any supposedly superior investment strategy should be taken with many grains of salt. The market is competitive enough that only differentially superior information or insight will earn money. The easy pickings have been picked. We conclude that markets are generally efficient, but that the reward to the especially diligent, intelligent, or creative may in fact be waiting. We are at the end of session 2.3. After having carefully studied the slides and relevant chapters in the book, please start with the review questions.